Okay, welcome everybody. Thanks for sticking around on a Friday. One thing I say at the beginning of all these webinars, this is being recorded, and I do implore you to watch it again very shortly after. The reason is because some of the nuances may go by you the first time through, especially if you're a newer trader and or new to this particular strategy, a short straddle with no upside risk. Yes, it seems very easy, but I do have a lot of rules that go in and around this in order to increase your probabilities of success. And that's what it's all about. That's what I teach. Anybody can teach you how to do a short straddle and create it without upside risk in a sense, but I'm going to have particular environments and little nuances that go into this that increase your probabilities of success that I learned on the floor as a trader there. You know, one of our major things was volatility and how that affected the different options and when it was a good time to get into a trade and when it was a bad time to get into a trade. Sometimes we didn't have the opportunity to pick and choose which strategies we got in because we needed to make markets. So believe me, I've learned by taking on bad trades even at a time where I didn't want to didn't want to take on that trade. So I know when they are bad trades and would scramble to get out of them immediately. But just to make the market, we would have to take on some trades that we didn't necessarily want. So it wasn't always the best of the worlds down on the floor. Everybody thinks it was a cakewalk, but a lot of times you had to do put on some trades you didn't really necessarily want. But this is a straddle with no upside risk. I do have to get through a couple of things real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. I've basically been trading my own money for over 25 years now, and started out trading in college, went to college with to get a psychology degree, and about a year and a half into college, I decided to switch it over to finance because I was trading and thought, you know what, this is what I want to do. And after getting my finance degree, I moved up to Chicago, started working on the board of trade, and started out as a runner and moved into the pits later on and started trading my own money. So I've seen a lot of markets, and I've traded in almost every market. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. As you can see here, that was a real fun day. Anyway, this says any opinions, news, research, and analysis or other information contained here or provided by ProTrader Strategies and associates or employees is to be general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. What all this is saying is the regulators, and I agree with this, say that I can't give you guys investment advice without knowing your risk parameters, without knowing what's in your portfolios. And that's true. Anybody out there that says, hey, jump off this cliff with me, you should really think twice about what they are trying to sell you, because at the end of the day, they don't know if it's right for you. So what we try to do is take different strategies, teach them to you so that you guys can implement them into your portfolios in your own way. And another way to think about it is we're here to teach you how to swim and not swim for you. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Can I get the recording? Yes, this is being recorded far ahead. Not sure. Tested sound was good, but now no sound. Is anybody else having a problem with sound? Can you guys hit me up in the questions if you can't hear me right now? You guys should be able to hear me. Okay, Jonathan's all good. If anybody has any problems with sound, like it starts going in and out, it usually has to do with connection or connectivity. And if you log out and log back in, then usually that kind of fixes the problem. But we are basically a couple of people away from capacity, so hopefully that doesn't happen to you, and that won't keep you guys from being in here. All right, so most people are saying it's all good, so just keep that in mind, all right? All right, so you can also follow me on Twitter at Wolfman's blog, especially right now during earnings season. I tweet out what my earnings trades are just for really the reason why I do it is for the people that are watching my daily market commentaries. Where I talk about every single trade I do. I will talk about when I get in them, when I get out of them, how I manage that risk, what I'm doing to be mechanical, and things of that nature. So I feel like I should supply those people with that. Those are not trade recommendations. It's just, letting you guys know what I'm doing. All right, so Straddle with no upside risk is IRA compatible. One of the things with this is we are going to have a short put in there, and they are going to jam us in the IRA for our margin. But at the end of the day, it's not an illegal trade for an IRA, which I don't necessarily agree with them limiting the strategies in IRAs and stuff like that. But that's a whole nother story and a different soapbox. So, and the assumption for this is going to be a market neutral to bullish. So at the end of the day, if you're worried about upside, in a sense, this would be a good strategy to put on. If you have a strong assumption that it's going to stay right here in this tight little range that it's maybe moved to, the way I usually put these on is if the market's kind of moved away from the point of control, which is Stoudemire theory or market profile theory. It's where the most time and volume's been spent. And usually markets settle down when they get to that area because nobody's making money and nobody's losing money, so it seems like everybody's happy. So it has a tendency to settle down there for like a week or so. So that's a great time to put on this strategy, especially if it's kind of rallied off the lows and settled down there. So that's usually when I like to put something like this on. But great one, especially in bull markets and things of that nature, because you can set it up where you can even still get a credit if it goes through your defined risk side. So basically what we're going to be doing is selling a short straddle. You start out with a straddle, which is pretty simple to do. It's selling an at-the-money put and then selling the at-the-money call. Basically, it's the same strike or the closest to at-the-money that we can get. And then you buy an out-of-the-money call with that credit that you received. Now, you want to make sure that the difference, say, for instance, if you collected $3 on a stock's trading $50, let's say, and the at-the-money puts are the 50 calls and the 50 puts. And let's say we collected $3.50 for selling that straddle. Well, we would want to buy the 53 calls in a sense. So that $3 we collected from this, go 3 ticks up, we'd get the 50 cents if it rallied up through 53 and kept going. So that would be able to be ours. So with a straddle, you would have to worry about some of that movement outside of that range. This we don't have to, which is the beauty in it. But every positive has a negative in a sense, right? So although we're limiting our risk to the upside, we are increasing our risk slightly to the downside because, we're paying some money for that defensiveness on the upside. So just keep that in mind. All right. So let's move on. So picking the right underlying. With the right underlying, you guys, this has to do with the right underlying being that it has good options trading. There's a lot of open interest in there. There's a lot of stocks out there, you guys, and even in the S&Ps, even in the Dow 30, some of those blue chip stocks, they just don't have the participation in the options, and for whatever reason that is, they're not sexy or whatever, but and they might have a really wide bid ask. So we don't want to trade anything that has a wide bid ask. And the reason why is because you got to give up so much edge to get in and so much edge to get out, and that eats at your yield. Aside from the fact that when the markets get busy, people will leave that one that was already pretty dead, and those bid asks will get even wider. And if you want to get out, it could be very difficult and could take several days. If you didn't want to give up that edge, waiting for somebody to just come in and pick you off. Rather than when there's a lot of participation in that underlying, there's going to be all kinds of people really kind of jockeying to get the better bid ask, and will eventually work their way to you. So that's the importance in picking the right underlying. And anything that's over like, you know, $100 stock, say a $300 stock or $1,000 stock, I usually say take that decimal point, move it 3 ticks to the left, and that's how wide the bid ask should be. So like a $300 stock, you know, you're not going to get penny wides usually. So you take that decimal point, move it 3 ticks to the left on a $300 stock, and you got 30 cents. So the ballpark on that should be bid ask 30 cents on something like that. All right, so then picking the right strikes. Now, this is pretty easy with the straddle, right? We're just doing the at the money, but at the end of the day, make sure that if you're defining your risk to the upside with this strategy and you want to have no risk to the upside, that you pick that long pick that long call that is being paid for by the selling of the straddle. And I'll get into the details of that when we get into the platform. I'll be able to show you. I think it's a little bit easier on a visual sense when we do that. But like I mentioned, making sure that if we collect $3.50, we're not picking the long call that's $4 higher, because then we would still have risk to the upside. So making sure that we are paying for that long call. All right, and then picking the right duration. Now, with this, it's really important, especially with the straddle, that we get to take advantage of this theta decay. And this is what theta decay, you know, generally looks like. It's not perfect, but it gives you a good idea as to when theta starts really eating away at those premiums. And that's what we want. Anytime we're selling options, we want theta decay to be in our favor. We don't want to be way out here where there's no theta decay and time is actually against us out here, right? Because it just the longer you're in this trade, the higher probability is that you're going to lose money in a sense. So get in here, get this theta decay, because a lot of times the way that we're going to set this up in a high volatility environment, high implied volatility environment, this line is actually kind of bowed out in a sense, and it kind of makes this line turn. And my pin's not working. I've tried it a couple times. Right? Let's go with the pin. So this line kind of goes out, and it's not going to work. It goes out like this. Because what happens with volatility is it kind of is like putting air into a balloon. It kind of flattens it out. You know, the bigger the balloon gets, the flatter it gets. And the bigger the balloon gets, the more pressure there is on deflating it. So when that volatility comes out, then you get it to catch up. So that's what we're trying to capture, is volatility crush is what we used to call it on the floor. And that's where you really get that accelerated theta decay, because when volatility comes out, all of the premium or a lot of the premium, I should say, comes out of those options all at once. So that's what we're trying to take advantage of. All right, and then picking the right environment. I mentioned this briefly. The right environment is we need high implied volatility, and every underlying has its own implied volatility. Okay, so you know, like Tesla probably has a higher implied volatility than, let's say, IBM, but IBM at any given time has implied volatility that we can rate against itself in the past. And that's what we're trying to do, is we want to try and determine when the premiums are at their greatest. And in high implied volatility environments, or when there's a high volatility in and around that underlying, that's when people are willing to pay the most for premium. And being a trader, that's when we want to take advantage of that. You know, we on the floor called volatility the fear factor. And the reason why it was a fear factor is because people were willing to pay more and would pay over and above what it's really worth, just to have protection, which, you know, for us on the floor, that didn't necessarily make sense, right? I mean, fear is always overstated. It's just like if you're afraid of a bug or afraid of snakes, that fear is usually overstated. It's not usually that big of a deal. Same thing in this. And if we can take advantage of that fear by selling premium, we're going, when the fear kind of settles down, we get to take advantage of that. So we want high implied volatility. Another thing we used to say on the floor, when there's blood in the water, that's the time to go fishing. So always keep that in mind. When there's nobody fearful, it's kind of like the contrarian view. And when there's nobody fearful, you expect that fear is going to seep into the market in the future. So you want to take advantage of that. All right. This is almost like an iron butterfly. Absolutely. But you're only hedging the upside. Well, with that, yes, sorry. This is like the iron butterfly, except we are taking that defined risk off of the put side. In an iron butterfly, we would have a long call and a long put. We're taking off that long put and only really defending to the upside. So we can get more credit is what it ends up being. And with an iron butterfly, you really need to be market neutral. So let's move on to the next one. And know your exit strategy before entering this trade. Because this is a lower probability of success type strategy, we're going to be willing to take less. And the other thing is, when we get into a situation where, and let me look at this here, we also want to get out of this strategy in this area, because once you get into this area, there's something called gamma, and gamma affects the pricing as well. And gamma actually increases dramatically in these last 7 days. And we don't want to deal with that, because if the market makes a little move, it can really cost us in our premium. Those premiums can start jumping around. And I'd just rather be out well before that. So in a strategy like this, I'm going to be looking at somewhere between taking about 30% of my max profit, because with the straddle, because it's right there at the money, it's going to take a little bit longer time to decay. Plus, you're getting a lot of premium up front. So taking a little bit less is definitely worth it in this scenario. I mean, you take a third, you're basically taking $1 out of something like this. And you stay away from this area here, because we aren't trying to gamma trade and things like that. We are just trying to collect premium, get this deflation and volatility, get that theta decay real quick, and get out of this rather quickly. So get in and get out of it, because the probabilities are against you in this strategy, which is why you're getting so much premium. So take a little bit less than what we normally talk about. So somewhere like 25–30% of your max profit, because otherwise probabilities are going to kind of come back to bite you. All right, so the max profit on any selling strategy is that credit you received. So anytime you receive a credit, that is what your max profit is. Given that, your max loss occurs when the underlying goes to zero. Now, we're not going to hold on to that long. So at the end of the day, we're going to probably hold on to this until it goes, about time and a half of our credit received. So if we collected $3, we'd be getting out when it was like a $4.50 loss. So I don't want to risk a lot more than what I'm willing to looking to receive in this strategy, because if this starts going bad, it can go bad quickly. So look to get out rather soon if this isn't working out right away. And then our break even is that short put minus the credit received. So whatever our short put is, if it was like the 45 put and we got a credit of $3.50, then our break even is at 41.50, right? So in that, we'd probably, if the underlying traded down to about $40, that's when we're looking to pull the ripcord on this trade and get out of it. All right, so without further ado, let's get into the fun stuff rather than all the boring stuff. So this is usually when I throw it out to you guys in the questions box. Hit me up with any underlying you guys like to trade. We'll walk through those steps to see if it fits along those rules, and I think it'll help you guys figure it out a little bit better, and then we'll see if it all works out. One thing I didn't mention, now we did say we want high implied volatility percent here. This is what implied volatility is. And basically it's telling us, you know, for Tesla, it's got high implied volatility, right? Well, is 46% implied volatility high? Well, we don't know that unless we look at where it is in relation to where it's been in the past. And you need to know this rather than just having it on your platform, how to figure this out. And really what it is as simple as you have a numerator and a denominator. In the numerator, which is on the top, you got 46. You take where it is now minus the low, which is 28, and then take that sum and divide it by the high, the sum of the high minus the low, and you get an IV percent, where it is in relationship to where it has been in the past. Now, one of the reasons why you need to know that is because if you look up here on the side here, we can see some of these don't have anything. It's like it can't figure it out. And the reason why is sometimes charts, that's not a very good example, but let's look at this one, will have those gaps in it, especially newer ones. And sometimes there'll be a break. See, there's a little tiny break right here in Macy's. That all of a sudden throws the kink in the armor of the algo that's trying to calculate that. So you need to know how to figure that out on your own so that you know if it actually has high implied volatility. So it's where it is now minus the low in the numerator, and you divide that sum by the sum of the high minus the low. And sometimes you will see that it is at 100%, and just because it's at 100% doesn't mean that that's as high as it can go. It can continue to go higher, so just so you guys know that. Another thing with this strategy is I don't like to put this in and around earnings myself. Doesn't mean you can't do it, because you know, that's usually when you're going to get really high implied volatility. If you do implement this strategy around earnings, do it the day of that event. So if the earnings come out in the evening, do it that day towards the end of the day. And if it's in the AM, then do it the day before in the last part. The reason why I like to do it in the last half of the day is because it gives you more of a clean number, right? Now, during the day, a stock could move 3 or 4 points. And if you get like a 3 or 4 point move, that can screw up your whole you could be really close to what the market maker move is right away, and your strategy. So just to keep that in mind. All right, the first guy coming out with it is Philip. He's throwing out Nike. Oh, and then we'll cruise down the list. So let's start out with Nike. Nike. So Nike's got pretty low implied volatility. They just had earnings spiked up. So right now I can tell you that this isn't above, like, you know, we want as high as we can get for one, but one of the rules of thumb is above 50 or so for a stock, and above 30 for like a ETF in a sense. So anything like that, we want that type of IV. And this is pretty low, so I can pretty much assure you that it's going to have a tight market in a sense. And I'll show you when we go into this. We want to get this 28 days. I know I was talking about like 35 days to expiration. This is just inside of that, so it's still pretty good. But one of the issues is, I remember I talked about inflating these premiums, and the closest is the 60s here. So if we're doing it here, we're going to sell the 60 calls and the 60 puts. We're getting $2.04. So for one, with Nike, I can't even get that far because the next strike is $2.50. So I won't be able to limit that upside risk completely. So if I can't limit that upside risk completely, it doesn't really make sense to put on that defined risk in my eyes. Teresa, you picked mine, the one that I had already vetted. Good call. I won't let the cat out of the bag just yet. All right, so I'm going to skip that one. For one, it's low implied volatility, and you're just not able to get very far away on your defined risk because of the low implied volatility. Somebody else threw out XBI. I don't know if I recognize this one. Oh, the biotech ETF. Should have known that. So we're talking about an ETF here. So something above 30. The reason why you want to go a little less on the IV, it's never really going to get super high implied volatility because it's a basket of underlyings, you guys. So all of those will weight against each other, average out, and it will usually be lower than, like 50, 60, 70. Obviously we'd want to do something with like an 80, 90 IV percent here. All right, so again, I'm going to kick that to the curb, and the reason why we can look at it, it's trading 80, 81, or closest to about 81. Let's go with the 81s then. So we're going to sell that, sell the 81 puts. We have $4.50. So, we're only going to be able to go out about $4. So, $4.50. I'm probably really only going to be able to go out $3 to get those, to make sure that I can pay off all of those calls. So see how I did that. Despite the fact that I probably wouldn't do this one, it's set up pretty good. And you can always look at the charts and things of that nature to figure out where you want your defined, if that fits with your defined risk on the 84s. But this, we're getting enough of a credit in the beginning. We're getting that $3.52 in the beginning, and that covers the difference between the two calls. 81 to 84 is $3, right? So that credit pays for that side of the spread, and you get a 50-cent kicker, which means that if it blasts all the way up to 93, whatever, it doesn't matter. We paid for that already. Okay? See how that works then? All right, Rick, yeah, Google reports next week. Yeah, a lot. We have a lot. We're in the heart of earnings season, but, you could do this in and around. So for instance, the market maker move is $2 or 50 cents on this one. So that actually might be a decent one, but I would worry about the biotech industry. Anytime these guys have like results from their drug tests, implied volatility just explodes through the roof. And it's really kind of wanky when that starts happening. I mean, you have to really be into the biotech sector, which I'm not necessarily, but you got to really know when those things are coming, because that can just blow up in your face, especially with a strategy like this. Because it could go nowhere and that implied volatility explodes, and basically those strikes you sold are going to get very expensive. So you might be directionally right, being it's neutral, but all of a sudden these premiums explode because people are looking for protection or putting on bets, and it will hurt you. So just keep that in mind. Can you show this on the analyzed graph? I will, Dominic, as soon as I grab one that I come up with that's pretty good. So I think it's the next one was AAOI, which I'm not sure. Applied Optics. I'm not really heard of this one. So let's look at this. So $90 stock, right? $90 stock. So we should have 10-cent wide because we move it 3 ticks, 10 cents ish. And we're at almost 60 cents. So this is one of those situations I was talking about, you guys. I mean, the stock may trade quite a bit, 5 million in volume. That's good. That's a good volume underlying, right? 5 million in a day, that's good. $90 stock, but nobody's in here. They aren't even going to be in the weeds in here because it's just too wide. So we could even look at volume and open interest, and I'm sure they do have pretty decent open interest and pretty decent volume, but for some reason these bid asks are just super wide. So you might have to give up 50 cents to get in, 50 cents to get out, and that's just really going to eat into your overall yield. They do have really good implied volatility, so that's why these premiums for like an $80 stock are like through the roof here, because it has high implied volatility. So that part of it would fit. I don't know if they have earnings, or maybe they have some kind of something coming out, which could drive that up and drive this volume up. So it looks like a lot of this volume is happening mostly today, or at least a quarter of the volume, open interest is in today's trade. So some news or something, but those are just really wide. So I don't think I would do that one. So all right, on to Teresa's. She did the one that I vetted today. Alta. It's a good stock. Has good volume and open interest. The 25-cent wide, and I will assure you, I was even looking at this one today, and it's a Friday. Friday, people are going to be pulling their orders, and maybe that's part of the problem with the last one I looked at. Friday after the close, nobody's leaving stuff in here over the weekend, so these will get a little bit wider. But Alta, generally speaking, will have inside a 25-cent wide bid-ask, and it fits that rule. So although it doesn't look like it right now, it usually does. And I was looking at this one earlier today. So it's traded, and actually I was looking at it when I was trading right about $250. So it looks like I had a late day rally to come off the lows. And this is another reason why I like it. If you look at it, it's kind of broken out in a way and then really came back. It doesn't have earnings for quite some time, but it's right here at the point of control. It has high implied volatility right at the point of control, which is where the most time and volume has been spent. That means that's where the most money has exchanged hands. So that's what I was talking about. Everybody's happy when they're not making money or losing money. The shorts aren't making money, the longs aren't making money, and everybody's just kind of like, okay, I can kind of forget about that one right now. And it just settles down. They aren't fighting back and forth. So that's another reason why I was looking at this one. So high implied volatility right at that point of control. Seems like it's going to want to settle down a little bit. And with that high implied volatility, you're going to get pretty good premiums. So it's going to be a pick 'em between the 250s and the 255s. So I'm probably going to lean towards these 255s because that's closer to where that point of control is, in a sense. So if we go to the 255s, I'm going to sell these sell the puts at 255s, and then I'm going to define that risk. I'm getting $13, so I got to kind of weigh how far out I can go. So I'm thinking I can probably go out about $10. So if I go out $10 from the 55s, that puts me at the 65s, and $10 looks like I'm going to be paying around $2.50 for this. So that means that the difference between, subtract the $2.50 from that 13, that keeps us inside of keeping that $10, right? So that's how you can pick those. Look at what kind of credit you're going to get. If it's like $13, then you can probably go out $10 on a big stock like this, and I was able to do that. So that's kind of how you go through those steps to figure that out. So $10 pays for the width on the calls, and then I get to keep 95 cents if it rallies up to 70 or 80 or 300. So it can continue to move higher, and I at least would get to keep that dollar, which is nice. All right, so let's look at this on the Analyze tab, and of course it's not going to let me do this that way. So let me just ping these out, make them even. So it's 1 to 1 to 1, and then we can look at this on the Analyze the trade. All right, so here's the risk profile. You can see right here is where the underlying is trading. If it rallies up to that 255, then that's when we're going to get the most bang for our buck. Obviously, if the market goes down, we have unlimited risk to the downside, as we talked about it going to zero basically, but that's going to feel unlimited. But I talked about this. If I'm only going to be willing to go $15 to the downside. So if it goes from where it is now, 52.5, let's just call it 55 to 40, that's probably where I'm going to be getting out. About $15 to the downside there. But here's the profile to the upside. You can see that it continues to rally. There's still a profit above zero here, and that's that $95 that we get to keep there. Let me see if I can do this real quick. I was playing around with this the other day, and it wasn't. I was getting it to work out for me. So this is volatility adjustment. So if volatility goes down on this strategy, it's not. I thought it was going to change the risk profile or premiums a little bit, but it's not going to. It's just bringing in the 10% range on that. So that isn't working. So if you're market neutral and bearish, you can do the same thing except have the long out of the money put and no call. Absolutely, Rick. That's exactly what you could do. Can you show this on the risk? Show this risk profile for the trade. That's what we're talking. That's what you're talking about, right, Kashish? So this is a really good example for sure. And they have no earnings and stuff like that. So high implied volatility, no earnings, and that's why we're able to get that fat premium for that straddle. Aside from the fact that it's a high dollar stock. All right, we can look at a couple more. What is it? NCR. Oops. Because I hit X a couple of times. All right, so let's close out the 50s here. So 32 IV percent, so it's pretty low. And, they just had earnings, so you're getting that volatility crush. If you thought it was going to continue to get volatility crush, then, and go down to these lows, which looks like it has a tendency to do, then, you could still do that play. Because they're obviously not going to have earnings in here. And if you thought it was going to settle down right around in this area, then yeah, you could probably look at doing this. So in that, it's the 40s are probably the closest. It's got 10-cent wide ones, so that works with my rule. Could get a little iffy or a little dicey, but all right. So we're getting $2.09. So we could probably go $1 to the upside and buy that one. Because if I go, because $2, if I go, actually, no, I could probably go up higher than that. So I did the 41s. Let's look at the 42s. So the 42s, nope, see, we're not going to be able to get that. $2 is not going to work. Oh, what did I change? I did something wrong there. Sorry, you guys. Let me start over. So it's $39 stock. I did it wrong. So 40s. So those. So we did the 40s. $2.59. So I should be able to go $2 higher. There we go. So I am able to go $2 higher and cover that. So that would work if that was your assumption. It doesn't really fit the high implied volatility necessarily, but it just had earnings, so I wouldn't see that it would have a spike. So that's pretty decent implied volatility for right after earnings. Usually they go down into the teens. So if you thought it was going to continue down to the teens, that's something that you could make that assumption on. If you're under the assumption volatility in that underlying is going to go down, then this will work for that. But you need volatility to go down and not up, because it can stay right where it's at. And if volatility goes up, that's going to hurt you. Does that make sense for everybody? All right, so another one was Apple. I think Apple has pretty low implied volatility right now. We can just close this out. Oh, it's 77. What? Oh, they have to have earnings coming out soon. Yeah, it looks like when are their earnings? So their earnings are coming out in just a few days. So there's no way you're going to get the volatility to come in at all for that. But because they're on 8-1, they're like basically right here. They're right there. So that's when they have earnings. But we'll just look at it for an example because you can see how, like it's $150 stock. We can just try and compare apples to apples. $150 stock. You can see they're like almost $4 for the calls and the puts. Now, if we go way down here, somewhere down here and look at IBM, it has low implied volatility in the 15s. That's close enough to 150, isn't it? For that. And you can see those other ones were closer to $4 for those at the monies. These are a lot cheaper. It's not a very, super good example because the other one was closer to 50. Let's see. I find another one that's 150. Adobe has relatively lows, but that's not. Well, if you look at the 150s right here, you can see that's almost $1 lower for the calls and the puts to Apple. 150s here, 390. See that? So you're getting an extra dollar premium on the calls and the puts, which is an extra $2 in either direction, right? If you can collect an extra $2, that's huge. That's a huge perk. That's why you do it when there's super high implied volatility, because when volatility comes in, that's the benefit. Volatility comes in, this decays really quickly. So $7.75. So we can't go $10. So we'd have to look at the 55s to buy. And that gives us plenty of room. So although if earnings weren't around the corner, that would be a good example, aside from the earnings aspect. Bud. I don't trade Bud that often. They do have, and maybe I don't trade Bud. I can't remember the last time I traded Bud, actually. Probably should start looking at it more, but it's kind of wide now, and it could be because it's a Friday. So 115, we're looking at this 114. The closest to the at the monies are these here. So you'd sell the 115s, see what our credit is. We're getting $6.70. So we're probably going to have to look at the $5 ones and buy those. And you cover your distance between the two calls, and you got some spare change on the side if it goes up. So they probably got earnings coming up too. Yeah, their earnings are next week, it looks like. The 27th, yeah. So, if you were worried about the upside but thought it was going to stay right here and stay inside the market maker move, which is, if we look at, it's not going to give us the market maker move because we got to get that July off the board. But sometimes, like the market maker move, which is part of the earnings webinars that I've done, when you can figure out what the market maker move is up here, and I actually even, it's basically, I give a formula for it, and you can figure out what the basic move is for that earnings event. And if it was inside of $5, then you might do that. Does anybody else have any other questions? But what we've done with this is taken a strategy that is a lower probability strategy because, we're selling right there at the money, which is basically 50-50 probability of success. And we're increasing our probabilities dramatically by buying that call because we limit any upside move to the upside. There's a 50% probability it'll go down, 50% probability it'll go up based on the deltas. But we've increased our probabilities dramatically because anything to the upside is a winner. So we've completely erased this risk to this side. So now our probabilities of success have gone from like 50-50 in a sense to almost 75% probability of success. So that's very nice probability, especially when you're talking about buying a stock as 50-50. Going to Vegas and playing anything at the casino is worse than 50-50. It's, better 50-50 for the house, but for you guys, or for me, walking into a casino and putting money on the table, probabilities are against me. This strategy, the probabilities are in your favor. So much better odds of success. And that's how I teach. I mean, I don't know if you guys, I see some very familiar names and faces, and I know you guys have been around for a while, but then again, we also see a lot of new people that I'm seeing today. And I play it for all probabilities, and that's how you become successful in this. As when you stop thinking about it as money and you think about it as probabilities and stick with that, you become more mechanical, you guys, and that's how you become more successful. Is if you can erase that thought, that emotion of money, then you will be a much better trader. And that's the hardest thing to do when you're first learning to trade. And one thing that I say that probably suited me the best was when I was trading on the floor and I had that psychology minor with my finance degree, and people in school were laughing at me, and it was just because I just kind of fell into that because I started out as a psychology minor or major and just kind of turned it into a minor to have a minor, but my major was finance. But I said on the floor, that psychology degree was more valuable than my financial degree, to be quite honest, because it has to do with your emotion and how you trade this. So and staying away from that, getting tied into it and stuff. So at the end of the day, trade with probabilities, forget about the money, because if you trade with the probabilities, you basically get that mindset like, okay, well, this one went against me, and you pull the ripcord on it, you get out of it rather quickly rather than riding it into the dirt, and you move on. You're just like, hey, the probabilities weren't in my favor on that one, move on, keep doing it. Probabilities on this are 75% success rate. If it goes against you, okay, well, that was one of the 25%. Now if I do it again and again and again, the probability is in my favor going forward. So make sure you take advantage of that. And what kind of gain do I try and get? Something like this on a $5 one, I'm going to be looking at, about a third, 30% of this. So if you watch many of my webinars, I like that third, 33% in a sense, because that increases your probabilities again, right? If I'm trying to ride this all the way out for $5 and get all that, it's like I said, bulls and bears make money and pigs get slaughtered. That's what that is to me. Is you're in this to make some money. If you can get a third of this, which is, what's a third of $5, somewhere around $1.70, $1.80, something like that. If I can get $1.80 out of this, I'm probably pretty happy. And if I can get $1 out of this in like 3 or 4 days, I'm definitely taking that because I know the probabilities are in my favor. JQ firing it off, probably did that in his head, $1.74. But yeah, something very close to that. What 3 or 4 techniques or strategies do you use the most? And can we come up with 100 techniques, but they're not all bread and butter winners? Yeah, so my top strategy, I mean, if I could do a strategy every day, which I don't suggest doing, you guys. I mean, at the end of the day, even though I have my favorites, you have to throw in some other strategies in and out to mix them up, because if you're beholden to one strategy and the market does something wanky, then you're beholden to that. So in that I sprinkle in, even though I don't like to buy call spreads or put spreads and things of that nature, I put them in there because I may have a directional assumption with the underlying, and it has to do with the environment. If the environment says that there's low implied volatility and I want a directional trade, then I'm going to have to do something where I buy options premium because volatility can't get any lower. So I know I'm buying those at a very cheap price. And if volatility expands, I could be directionally wrong and still make a little bit of money. But for the most part, one of my favorite strategies is basically short naked calls, puts, or iron condor. That would be my top. If I could always have high implied volatility and get that volatility crushed, then those are the top ones. And those are the strategies I use in and around earnings. I'm always selling calls, selling puts, and selling strangles. So that's what I use for earnings, and that's because that's my favorite go-to for high implied volatility. If I am not really sure about directionality, when I use a straddle, I don't really like straddles a whole lot because you got to pin it right there. I usually do one of these, a straddle with no upside risk or a straddle with no downside risk. I kind of pick my assumption, weigh my risks on directionality, and then throw that on there. All right, does that make sense, Farhad? Selling premium at a rising IV around earnings. No, so basically I sell premium around earnings, but I'm doing it right at the end of the day, basically, the last half of the day or last hour or so, maybe even 15 minutes of the day. It's when I put on those earnings trades because the market can move up and down all day long, right? And if I put that on early in the morning, IV is probably not going to expand that much during the day, so that's not going to hurt me. But what's going to hurt me is that, especially if I do an iron or if I do a strangle, right? And the underlying in the morning opens up at 150. And so I put on the, 135, 165 strangle. And that's outside the market maker move. But inside the day, it goes from 150 to 155, 157 maybe. And now my puts, are probably not going to get hit tomorrow. But now if they come out with good earnings, I'm likely in ice or in the sights of the market moving into my calls. So I like to do it at the very end of the day so I can get a clean number, get my clean distances away to get those probabilities right. Because your probabilities are going to change throughout the day. Rick says he finds that the IV is best around 1 to 2 hours before the close. It seems that the market tend to reduce the IV to the close during earnings day. And you might be right, so yeah, my 1 hour, right around an hour to go in the close is probably right around there too. And you're right, as a matter of fact, the closer you get, I have seen where I've checked out strategies in the middle of the day and seen that IV come down a little bit heading into it because people are done jockeying around, right? So 1 to 2 hours. Second half of the day, afternoon on earnings is the best time for me. So after 2 o'clock or something like that. Learned another Wolfman hack for manually calculating the fly percentile. Thanks. Good to know. Thank you. So that's about all I got for you guys. I mean, play the probabilities. That's the best way to keep your head in the game. And we got this offer right now. It's basically options course, how to trade like Wolfman, how to set up your options screen, measuring your delta. There's a couple of hacks in here, measuring time decay, how it's in your favor, using gamma. We talked about gamma earlier, how to use that in trading and trade that using market profile to trade options. I use market profile all day long. So if you guys watch my daily market commentaries, which I hope you do, I talk about the market profile quite a bit in there. One of the things protecting your portfolio with options, especially in a rising interest rate environment, that is huge right now, you guys. You guys don't realize how much risk there is in bond portfolios. You think that that's your safe haven, but in a rising interest rate environment, it can decimate a portfolio quickly. And I show you that on a couple of graphs that will really be eye openers. So basically, click on the link in the box there, which I guess I'll throw one in there. I got to find one. There's a link in the chat box. We've been going back and forth on the questions box. In the chat box, there's a link for this, which you guys should take advantage of for sure. And I can't get that link copied. So give me 1 second, and I'll throw that link in there. And not working. Wow. So that was a fail. Hold on. Give me a second. Let me see if that worked. There we go. There's the link in that chat box. So basically, I mean, you guys are going to be better off if you trade with probabilities. At the end of the day, that is the way to be mechanical and stay in the game. That's how I started trading, and you guys should really be trading with that kind of knowledge at the end of the day. Best way to become a better trader is to constantly learn, and obviously you guys are doing that, and I implore you to consistently do that often. I mean, I'm still trying to learn. So, you know, you guys have already made that. But wouldn't you say that knowing how to create option strategies and just trading with the technicals is not enough to create consistent winners? I mean, I'm a technical trader. I trade options, but trading, what I'm trying to say is basically trading the probabilities will help you become more mechanical. And is the only way to get ahead in the game. And that's how I teach this. If you guys watched any of these, you know that's how I play it. I play it by the probabilities, even when I'm trying to be mechanical. When a trade goes against me, that's the way to know whether you should be staying in it. If the probabilities are beating you, whether to pull a ripcord, whether you're just getting tested on it. I teach you how to figure those things out and how to stay mechanical and increase your probabilities even further, which is, you know, truly the only way to create alpha. And you guys hear people talking about creating alpha and da-da-da-da-da. Only way to really create alpha is with options. And that is because of the probabilities. That creates your alpha. So when you're using the right tools in the right situation, you basically become a more productive state of mind. You put more strategies on, which creates more opportunities and ultimately builds your confidence. And that, when you're confident, you are going to be a much, much better trader because you don't worry about it. You're more like looking at it under a microscope and thinking, okay, these probabilities are my favor. I don't really need to worry about it. Rather than the unknown. The unknown is when we become fearful, and that's when volatility in ourselves goes higher, right? So basically, we're offering that trial in that chat box today so that you guys can get this, basically can pay for itself, especially just even alone in your interest rate, rising interest rate environment in that portfolio that you probably don't even worry about because you're constantly trading the stocks and things of that nature. You're like, oh, those bonds, those are fine. Well, they're not. You need to be diligent with that, especially right now. So if you learned anything at all, you know you should be trading with this. So what do you say? Go ahead and click on that link right there in the chat box. Take advantage of it. We'll get you set up right away. If you have any questions, you can reach out to us at trading@protraderstrategies.com or call us at 310-598-6677. Talk to the guys when they buzz you on this and let them know how this was for you. I appreciate the feedback. So it's the only way for me to get better in these webinars is to know what you guys are thinking and things of that nature. So later webinars, we're going to be drilling down on different options components, how to trade them, when and where I find them appropriate, especially in those daily market commentaries. So take advantage of those daily market commentaries. I mean, that's the nooks of it all, is showing you how to be mechanical when a strangle goes against you, how to be mechanical when this particular strategy goes against you, how I'm working that out. So I want to thank you guys. This is also the link. If you guys are watching this on a recording, you can pause it and write that down. But if you have any questions, like I said, here's the digits and here's the address. So reach out to us. All right. I see a couple of people were blasting me with some questions. I'll get to those in just a second here. But like I said, that's the link, or the easiest way is in that chat window. So let me try to get to some of these questions real quick. All right. Farshid, I said yours. Can you expand on the volume profile? Yeah, I can here in a second. Do you at all look at the indexes, currencies, commodity futures in your strategies, or restrict it to stocks itself? Ramesh, I do look at the currencies and commodity futures. I've kind of gotten away from currencies lately, but I do look at the indexes all the time, especially and ETFs. I look at those, but the indexes for sure. But I usually look at the indexes and the commodity futures and then go to the ETFs to trade those. And the reason why I've kind of gotten away from those commodities is, for one, they're a large margin drag, just because they're if you have a ton of money in your account, you can trade those, right? So, but a lot of the people that I'm teaching and are watching my stuff, that doesn't interest them as much. So I've geared myself over to the ETFs and things of that nature. But you're right with commodities and the stuff that's like the Merc, you can get a lot better commission rates. Did you tell us how to estimate the market maker move? If so, I missed it. Yeah, I didn't, Patricia. Basically, market maker move is you take the straddle times 0.8, which is 80%, and that's what the market maker move is for basically the overnight on an earnings. That's only on an earnings event. You can get that. How do you set up the market profile in the chart? Jonathan, I've got a whole webinar on that, and you can reach out to us to set that up, because it is, being a psychology guy, and thinking about how the mindset of the market is, that is a great representation of psychology in a sense, because where the most time and volume has been spent, that's where people are putting their money where their mouth is. When it gets to the extremes, that's where people are like, I'm taking my profits, or people are puking and getting out of positions at the wrong time. So I love watching that. It keeps you a little bit more mechanical and a little bit more sane, I guess. Who else was this? Is this video only, or is there a corresponding PDF to download also? This right now is only a video, but I am doing shorter ones on a few of these right now, but we don't really have a PDF. Interesting setup. Thanks, Wolfman. Appreciate it, Andrew. Thank you. Great webinar. No hard sale like most. I learned something and will purchase. I appreciate presenter who is not a hard sell. Thanks, Dan. I appreciate that. Thanks, Eric. Great session. Thanks, Mike. Sorry, meant special options course. Sorry, what were you saying? Corresponding. Are you talking about this here, HH? Yeah. So that's the link to that is in the chat box. Like, we're right now going back and forth on the questions. There's a link in there on the chat that you can just click on. It gives you a direct to this webpage. Thanks, Ramesh. Appreciate it. All right, you good? You good to go, HH? Cool. All right. You guys have a great weekend. I appreciate it. You guys all take care, and reach out to me if you got any questions or anything else. And like I said, on Twitter, check me out. Trading some iron condors on paper, very new. I need to look at the recordings slowly to get all you said. Thanks, Patricia. Definitely. And I even have I have an iron condor webinar, so I have basically rules that you can make sure you're increasing your probabilities of success with Patricia. And I also even go in with that iron condor webinar on how to defend the iron condor when it goes against you. So make sure you watch that too, because you can stay mechanical. One of the beauties with iron condor is its flexibility and being able to be mechanical and defend that. Defend the iron condor. All right. Great. A couple more coming in. Okay, great. Thanks, Patricia. I need the iron condor. When's the next one scheduled? I don't have one scheduled for the iron condor, but I did one just not, I mean, it was about a month ago or so, but you can check that out if you write us at Pro Trader Strategies. They can get that to you. Webinar recording will be sent out as soon as I get off here. I basically have to compress this, or actually convert it, and then download it, and then they send it out. So it's going to take me probably an hour to convert this. It takes about 15 minutes to download it, and then they'll send it out to you guys. All right. Have a great weekend, everybody. Take care. Thanks for being here.